Yeah. Happy Wednesday, everybody, and welcome to the channel. I am Jordan Childs with the License to Sell team here in Keller Williams First in New York, and I'm here today with one of my preferred lenders to go over all things FHA loans, Jared. Jared, introduce yourself. Take the floor, man.
What's going on, guys? My name's Jared. I'm a mortgage broker here licensed in New York and Florida, and psyched to be talking with you guys, psyched to be chatting with Jordan about one of my favorite loans, one of probably the most underrated and underutilized loans that a lot of people know a little bit about, but I don't think many people know everything that FHA loans have to offer.
Exactly, man. Especially, I understand that fully as a real estate agent. When I talk to my clients, sometimes I get a bad rep, but when used correctly and when you know all the information and all the programs that are out there with FHA loans that we're going to go over today, they are such an underrated tool. And one of the biggest misconceptions, which is why I wanted to do this with you today, was the email that you sent out, an amazing weekly newsletter. I definitely recommend you guys sign up for it. I get a ton of value from it every week. The biggest misconception out there with FHA loans is that they're only for first-time home buyers, which, yes, they are fantastic for first-time home buyers, but they're not exclusive to them. And one of the biggest advantages to using an FHA loan for anybody, not just a first-time home buyer, is that they require or they allow a higher debt-to-income ratio. Can you talk about that a little bit more, Jared?
Yeah, absolutely. And you're 100% right on the first time home buyer thing. I hear so many people I talk to and they think FHA stands for first time home buyer, and it's Federal Housing Administration. So FHA loans, they're government insured loans. And one of the big benefits of being a government insured loan is that for the lender, for the person who's actually writing the loan, let's say if the loan or the note fails to perform and someone stops making payments on it, those lenders can be reimbursed essentially by HUD, by the insurance that they're getting through the FHA program. So what's this mean for a buyer? What this means for a buyer is that they're willing to do things that might be considered riskier. And a lot of the time we hear risky and we think this is a bad thing, right? For FHA, that's not the case. One of the biggest benefits to an FHA loan is exactly what Jordan mentioned. It's the higher debt to income ratio. So with a traditional loan, most banks want to see when you buy a house that essentially your total debt and housing expenses are going to be somewhere around 43% or less of your total income. Now, one of the things that's tricky about this is that there's a lot of income that banks don't consider. I mean, I talk to lots of customers, maybe they work a tip type job, or maybe they work off the books, or maybe they haven't been at their job for 2 years. So they could be earning a substantial income that the bank is just flat out ignoring because it doesn't count as qualified income under the guidelines. And so in circumstances like that, the flexibility that FHA offers is up to a 57% back end debt ratio. This means that you can take the same amount of income and qualify for a lot more loan. It makes a huge, huge difference. So especially for, this isn't something where you want to take it and you want to say, oh wow, I can get a really big loan. I can buy something that I can't afford. Let me use it that way. It's the wrong way to use it. But the real benefit to it is for folks who are maybe two income households and only one borrower is going on the loan, or folks who maybe have a second job that they haven't been at for 2 years, or maybe that get a big bonus or work a lot of overtime and the lender isn't necessarily giving them full credit for that additional income. So it can make it much more achievable for much more people to secure financing on a home.
I actually have a house that I'm closing on, I think in the next 2, 3 weeks, where I actually have a client, the same exact situation. It's a two-income household, but they're only using the one income for that reason because the FHA allows it. And just quick for the people, what is the debt to income ratio on other financing, like a conventional loan, FHA loan that allows, compared to the higher debt to income ratio that an FHA loan allows?
Sure. So many banks like to see a 43% debt to income ratio. Conventional guidelines, so probably the most common loan out there is a conventional loan, and it will let you go up to a 50% debt ratio. But at a 50% debt ratio, it's a lot more challenging to get those conventional files approved. So there are circumstances where you may have a borrower who has a 45, 46, 47% debt ratio and technically should be able to qualify for a conventional loan. But for some reason or another, the automated underwriting in conventional findings is not approving the loan. FHA gives more flexibility. It gives them a little bit more wiggle room. And I've seen a lot of cases where someone who on paper should qualify for a conventional loan cannot. And if these looser guidelines, if these FHA loans didn't exist, there'd be a lot of my customers who didn't own homes today. And I mean, just looking over the last 2 years, the folks who bought in the last 2 years are so thankful they were able to buy because they've gotten so rich in equity. So it makes it much more achievable.
Awesome. And another amazing thing with FHA loans that they allow is the lower credit scores. Can you talk to the people a little bit more about that? Because one of the biggest misconceptions, I'm sure you hear it, I hear it in my buyer meetings, is I have low credit, I can't buy a house. Talk to us a little bit more about that.
So that's another area, and there's a few pieces to it that make FHA super appealing. And you're right, I talk to a lot of people. They maybe have a credit score somewhere in the mid sixes, and they're like, I can't buy a house. I don't have a 700. I don't have a 750. I don't have an 800. FHA loan. Whenever I tell people how low you can go on an FHA loan, they're like BS. I mean, you can't get a credit card with this low credit score. FHA goes down to a 500 credit score. So 500, it will allow very low credit scores. Now, granted, the lower the credit score goes, the worse the terms of the loan will be. And if it is at a 500, you lose some of the benefits like the ultra low down payment. So if you're anywhere from 500 to 579, it's possible to get financing with a 10% down payment. If you're anywhere from 580 and higher, it's possible to do it with a 3.5% down payment. So that on its own, I mean, makes a huge difference. I got a lot of customers who, are sitting somewhere in the fives, in the sixes. They've got great income. They do pay their bills on time, but they went through a messy divorce. Their husband ran up a credit card or something. Like, things happen in people's lives. And, particularly in those circumstances, you'll see someone is going through a messy divorce, or there was a sickness in the family. They fell behind on some bills. Now their credit's in rough shape and they need to make a move. And, this is really where if they had to get their credit up to 700, they could be waiting a year, 2 years, 3 years, 4 years before they ever qualified. And because FHA financing allows for those lower credit scores, again, if you can show that you can pay the bill, if you can show you have stable income, if you can come up with a down payment, FHA is going to make it much more possible to get financing.
And imagine those people with the lower credit scores if they did not know this information and they waited 3 years, 4 years, 5 years to get into a home. Look at how much homes have already appreciated. It's
For
it's the
sure.
cliche, it's the cliche. Everyone's heard this saying before, but the best time to plant a tree was 20 years ago, and the second best time is today. It's the same exact thing with housing. If
100%.
you just if you look historically, houses are going to continue to going up. So if home buying is one of your dreams, one of your aspirations in life, do not poo-poo these FHA loans. They are there to take advantage of, and there's so many amazing things that come with them. And another thing that I wanted to get into with you as well is the competitive interest rates that FHA allows.
And that's another really big kind of thing that a lot of folks don't realize. So if I price a 30-year conventional loan for a borrower who has, a 680 credit score, I'm not going to quote rates on it, but they'll get a certain rate, right? And an FHA buyer, in most cases with the same credit score, is going to see somewhere around a 0.5% lower on interest rate, almost always. And the difference here, the disparity here gets even bigger as the credit scores go lower. So if you have someone with a low 600 credit score who could go conventional or go FHA, you could see a 0.5%. You might see a full 1% difference in the interest rate for FHA versus conventional. And again, this is because low credit scores tend to be looked at as riskier by lenders. But when a lender's writing an FHA loan, they have a get out of jail free card if the loan doesn't perform. So the federal government, HUD, is saying, hey, we want people to be able to buy homes. As long as they meet these set guidelines, we're going to give you some safety so you can lend money to people in these situations. So it really is a terrific program, and the rates are significantly lower pretty much across the board.
That's amazing. And then another prop that comes with that as well is the generous seller contributions, which is the way that you worded it. Can you talk to us a little bit more about that? Because it's another thing that people don't realize with FHA loans.
Yeah, so seller contributions or seller concessions, the biggest use for something like this is to cover closing costs on a purchase. I'm sure you deal with it. I do all the time. Customers who are buying their first home in particular, it doesn't have to be, but oftentimes their first home, They've saved their money for the down payment. Now they feel like they're ready to go buy a house, but in many cases, they haven't properly prepared for closing costs. Depending on where you're buying, closing costs can be bigger than the down payment in a lot of cases. So on an FHA loan, you're putting down 3.5%. If you're buying a house in New York, by the time you pay closing costs, escrows, attorney fees, insurance, taxes, everything all in, it's probably closer to 5% that you're paying just in those closing costs. So if you have a $10,000 down payment, you probably weren't ready for your $15,000 in closing costs. What the seller contribution allows you to do is if someone makes an offer on a house that's say $300,000, if they offer it to the seller and say, hey, I'll give you 310 instead, and I want a $10,000 seller concession back, it essentially lets that buyer finance those closing costs that they may or may not have been prepared to pay for out of pocket. And this can be really beneficial because even if you have the money for your closing costs, right? Like let's say you have the extra 10, 15 grand you need for closing costs, there's still a lot of wisdom in having a little safety net, a little nest egg after you close. And the cost of financing, $10,000 of your closing costs, it might raise your mortgage payment by 50, 60, $70 a month. So for most people, having that extra cash after they close is going to be a huge benefit, because things break in houses, you have moving expenses. Sometimes people lose their jobs, unexpected things come up. And so it's just so important to have cash left over afterwards. And FHA loans allow you to go up to 6% seller contribution. It's compared to a conventional loan, if you're using a low down payment conventional loan, it's capped at 3%. So literally twice as much seller contribution you can get on an FHA loan.
You just can't beat these benefits to an FHA loan. And so many people just don't understand these things. They don't fully know them, which is why it's important to sit down with a mortgage professional, sit down with a real estate professional, and just talk about these things because these programs are out there for these people to use. And another amazing thing with the FHA loans is that you can utilize the non-occupant borrower's income. Can you talk to me a little bit more about that?
Yeah, and this is another thing that I think a lot of folks don't realize. I've got a customer, he's in Florida now, and his father lives in New York, and he's buying his first home in Florida. And it's a situation like we talked about. He works two jobs, he makes great money, but one of the jobs he hasn't been at for 2 years. So the income we can use to qualify him, it really isn't enough to get into the homes that he's looking at. However, his father, who lives in New York, can co-sign on the loan, and his dad has a tremendous amount of extra income. And so we're able to use all of his father's income to essentially strengthen the borrowing power for him, even though his dad will never live in the property. His dad can stay living in New York. He could never have anything to do with the house, but because he's co-signing on it, because he's adding his name to it, I'm pretty much saying, hey, if my son doesn't pay, I will. It strengthens the loan and we're able to push those through. So there's a lot of situations where it can make sense. This can be maybe there's a student, right? Like someone who just got out of school isn't earning that much money yet. Mom and dad want to buy a property for them when they go away to school or something like that, instead of paying for, campus housing. Great way to do it. They can use the FHA loan, very little money down, use mom and dad's income, and then just go ahead and put essentially that student who may or may not have income into the home.
That's amazing. And the last two benefits that I wanted to talk about, two FHA loans, we touched on it a little bit earlier, talking about an earlier topic, but the low down payment, it goes down to as low as 3.5%. Other financing is a little bit higher than that. Can we talk to the advantages to first-time home buyers, buyers in general, just anyone with the low down payment? Because people see that, and yes, there is the PMI attached, but there's still a benefit to putting the low money down. Can you talk to the people just a little bit more about that?
For sure. And this is a conversation I have a lot. PMI or MIP, it gets a really bad name. A lot of people say, I want to wait until I have a 20% down payment to buy a house. Well, if I have an FHA loan, I'm going to have to pay PMI. PMI on FHA loans, it was reduced by about 40% in the last year. So the actual cost of it has been drastically reduced. Just in the last 12 months here, it's come down by a significant amount. So that's one thing I would kind of acknowledge is that the PMI you were paying 2 years ago, much higher than the PMI you're paying today on the same loan amount. The other thing that I would look at is, you hit the nail on the head when you talked about how home values are continuing to increase. Historically, home values appreciate nationwide at about 4% year over year. right? So this means if someone's buying that same $300,000 house today, 3 years from now, 4 years from now, that's going to be a house that's likely worth closer to 315, $320,000. So if you do a comparison, hey, it's going to take me 5 years, 10 years to save up a 20% down payment. I've got 10 grand now. I need 60 to put 20% down. If it'll take you 5 years to save $60,000, then the same house you wanted to buy is going to be selling for probably above 320, $330,000. So while you can save a small amount on your monthly PMI, the opportunity cost of missing all that appreciation is so much more expensive. So it's one of those things where typically the sooner you get into a home, the sooner you start getting the benefits of appreciation, and the bigger those benefits will be across the term of that loan.
I couldn't agree more. And then getting into the house, FHA loans, VA loans, all these loans, they get a bad rep for sometimes a long closing process if things go wrong with the appraisal, etc. But contrary to popular belief, it's actually a pretty damn efficient closing process. Can you talk to me a little bit more about the timeline? Obviously, it varies. There's never going to be a blanket. You're going to close in 18 days, 30 days, 45 days. This is why you have so many professionals working for you when you're buying a home, because shit hits the fan. It's just how that goes in this industry.
Totally.
But
Totally.
FHA loans actually do have quite an efficient closing process that people do not realize.
There's really no reason an FHA loan should take any longer to close than a conventional loan. I mean, we're consistently getting them cleared to close inside of 21 days or less, which, for most keeps them pretty happy with their contract timelines. I think the reason it gets a bad rap is that there are times where folks will try to buy a house that is not a good fit for an FHA loan. And by this, I mean, FHA loans are not a good fit for something like a condo. Most condos are not eligible for FHA financing. If you try to push through an FHA deal there, it may not close, or it may take much, much longer to close because there's a whole separate set of approvals needed. But for single family homes and multifamily homes, they're a terrific fit. The biggest thing is just having a property that essentially is going to work with an FHA appraisal. So FHA loans hate lead paint. If you got lead paint in your house, there's going to be issues. If there's chipped paint, there's going to be issues. If you have safety concerns, like, you have a deck that doesn't have a proper railing, they'll tag things like that. So I would say in general, with an FHA loan, you want a house that is in move-in ready condition, that's safe, that's inhabitable. And one of the things that can happen with them is it is a stricter appraisal. But when an appraiser goes in there, and I've had it happen many times, they say, hey, there's some chipped paint underneath the window in the back of the shed. And they'll make a note of it and say, get that paint scraped off, paint over it. I'll come back once I okay it, we can close on this loan. So even when a home maybe has a couple of trouble spots or issues with FHA, there's oftentimes an opportunity to remedy those issues and still close on the home. And what can take time is, the back and forth of who's going to pay for it. So if something has to be scraped or a railing has to be put in, sometimes the buyer says, I don't want to put it in because I don't own the house yet. And the seller will say, well, I'm selling this house as is. As long as you've got an able and willing buyer and seller who want to make a deal happen, most of these deals can close very, very quickly.
That exact situation is what is going on with one of my deals right now. And it was no big deal at all. This is why you hire a trusted real estate professional to negotiate on your behalf. It was very easy. I said I would cover some of it, and my buyer covered it, and then we just asked them to install the carbon monoxide and the smoke detectors. FHA appraiser came back for the final inspection. Everything was good to go. We got the clear to close. We're good to go. It's really the FHA appraisal gets a bad rep, but a lot of these appraisers, they're gonna mark the stuff, and they're gonna give you a period to just correct it. And it's really not that hard. Sometimes you just have to paint over something real quick. Like you said, just replace something on the deck, put in some smoke detectors. It's not deal killers. You just have to get it done.
100%. A lot of the time you want to know about those things anyway, truthfully, as a buyer. It aligns with your wants and needs anyway. Like, if there's a blaring safety issue, it's kind of nice to have a second set of eyes on it that's pointing it out and saying, hey, that's a red flag.
Yeah, absolutely. Well, Jared, man, I can't thank you enough for this. Your weekly newsletter, I get a ton of value from it every week. I promise I read it every week. As soon as this one hit my email, I read through it. I was like, we got to sit down and talk about this. I'm going to get a bunch of value out of it, and so is anybody that's going to be watching. So again, I'm Jordan Childs with the licensed sell team here for Keller Williams First in New York. I'm a realtor in the Hudson Valley. I help a bunch of first-time home buyers, but I also work with sellers. I work with move-up sellers as well. And Jared, like he said, he is in New York. He's in Florida. He's one of my preferred lenders. Let the people know where they can find you, contact you, and all that good stuff.
Love to help you guys out. Yeah, follow me on Instagram at Mortgage Jared, and reach out to me if you got questions, concerns. I'd love to help you out.
Perfect. Jared, I can't thank you enough, man. Have a good rest of your day, brother.
You too. Take it easy, Jordan. Bye.
Bye.